Adjusting entries is the process of converting a company's accounting records to an accrual basis of accounting. This usually occurs when a company is about to issue its financial statements. There are no cash accounts during this process, as any unrelated cash flows will occur either before or after the end of the accounting period, when the adjusted entries are recorded. There are two most common types of adjusting entries: accruals and deferrals. Accrual is recording a revenue or expense that hasn't been recorded yet from a transaction, whereas deferrals is to defer an expense or revenue that's already been recorded but not yet earned or used. Accrual deferrals often impact an asset or liability account, where the accrual of an expense may increase the liability of the account. In this example of accrued revenue, Sue receives $50,000, which was earned but is not performed yet. Where after the period of which the service is performed, on the 31st of May, we are able to adjust the following entry, where we debit the accounts receivable and credit the sales. In the next example, Susan receives $100 from a client for a service that's to be performed in the future. At the end of the accounting period, Susan only performed half of the service. Since only half of the service was performed, we are to adjust the amount accordingly to only half of which was performed. Hence, we are to debit unearned revenue and credit service revenue, where 50% of 100 is $50. Hence, here there is a decrease in liability and increase in revenues account. This has been recorded as a liability as they only received the cash. The transaction entry for the journal entry is cash is 100, which is the asset, and unearned revenue is a liability, which is 100. Now let's go through a simple deferred expense example. Jack pays $8,000 for insurance coverage for his home on the 1st of April 2017. We are able to record the asset where the adjusted entry at the financial year for 30th June 2017 is to debit insurance expense and credit insurance.